Have you ever wondered if the home you're dreaming about could actually turn into a financial nightmare? Nevada, with its glittering lights in Las Vegas, the beauty of Lake Tahoe, and wide-open desert towns, might seem like a land of opportunity for buyers. But in 2025, things aren't always as they appear. Some of the very places that once promised growth and stability are now the riskiest markets in the state, where new homeowners are watching their equity disappear faster than the desert sun sets. In this countdown, we're diving into the 30 worst cities to buy a home in Nevada this year. You'll hear about towns where prices have dropped by double digits in just 12 months, places where homes sit unsold for half a year, and markets where entire neighborhoods are struggling to find buyers. Imagine spending $400,000 on a house, only to see it worth $30,000 less within a single year. Or picture moving to a town where there are more homes for sale than buyers to walk through the doors. But here's where it gets interesting. Even in these troubled markets, opportunities may exist for the patient, the strategic, or the bold. Could these so-called housing traps actually turn into bargains for the right type of buyer? Stick around as we count down from number 30 all the way to number 1, and you might be surprised by which Nevada cities made the list. And before we jump in, make sure to subscribe so you never miss our deep dives into the real estate trends that affect your money. 30. Henderson, Nevada. Henderson has long been seen as one of the more desirable suburbs of Las Vegas, offering planned communities, good schools, and access to amenities that make it feel like a safe investment. Yet in 2025, Henderson is no longer the sure bet it once was. The housing market here has flattened and is now showing early signs of outright decline. The median home price hovers near $495,000, and according to recent reports, that figure is actually down about 1% compared to last year. That might not sound catastrophic at first glance, but for buyers who stretched their budgets and entered the market just 12 months ago, it means their home is already worth less than what they paid. This matters because Henderson's appeal has always been tied to stability. When that stability falters, buyers are left wondering if they overpaid. A 1% decline in a city where prices are nearly $500,000 translates into a tangible loss of equity, often in the thousands of dollars within the first year of ownership. Combine that with higher mortgage rates that have driven monthly payments sharply upward, and you start to see why newcomers feel trapped. Housing affordability has become a real pain point. In fact, Henderson is now ranked among the least affordable large cities in Nevada, with typical households needing far more than the recommended 30% of income to cover housing costs. Another red flag is the length of time homes are sitting on the market. Properties that used to attract multiple offers within weeks are now languishing. This slower turnover signals that demand is cooling, and when demand slows, the pressure on prices eases in the wrong direction for homeowners. Sellers find themselves dropping prices to compete, and that becomes a cycle of lowered expectations. Buyers who thought they were investing in a thriving market instead watch as their property value inches downward, even as their mortgage obligations remain locked at historically high rates. Despite these negatives, Henderson is not without silver linings. For buyers who are patient and strategic, the softening market can create opportunities. Those who are willing to wait out the current cycle may find bargains that were unthinkable during the frenzied pandemic years when cash investors dominated. If values continue to slip in the short term, it may open the door for long-term buyers to secure a property below its peak price and hold it until the market eventually stabilizes. But make no mistake, in 2025, Henderson is a risky place to park your money if you are expecting quick appreciation. The combination of falling median prices, reduced affordability, and growing time on market makes it one of the worst cities to buy a home in Nevada this year. 29. Reno, Nevada. Reno has transformed over the last decade into a tech-friendly city with big draws like Tesla's Gigafactory and the appeal of nearby Lake Tahoe. But in 2025, the housing market here is beginning to crack under its own weight. The median home price is now around $550,000, which is nearly $150,000 above the national median. Even worse, that price is down almost 2% compared to last year. For homeowners who bought near the peak, that decline translates into thousands of dollars in lost equity within a short time. The slowdown is also showing up in how long homes take to sell. Properties in Reno now average 53 days on the market, up significantly from the rapid sales pace of just a few years ago. This indicates weaker demand and reduced competition, both of which put downward pressure on prices. Buyers who once assumed they could quickly flip or build equity are instead facing stagnant growth or even outright declines. That is especially concerning given that mortgage rates remain elevated, making affordability worse and squeezing new households. What makes Reno risky is the imbalance between income levels and housing costs. Local wages have not kept pace with the rapid increase in home values over the past 5 years, meaning many households are stretching budgets to afford homes that are already showing signs of depreciation. High property taxes and rising insurance premiums only add to the burden. For those willing to take a gamble, there may be some opportunity if prices fall further, allowing long-term buyers to get in below the peak. But in 2025, Reno is a cautionary tale of a city that priced itself too high, too fast. With prices sliding, demand slowing, and affordability at its worst, Reno is one of the toughest places in Nevada to buy a home this year. 28. Carson City, Nevada. Carson City, Nevada's capital, has long been attractive for its small-town feel and proximity to Lake Tahoe. But in 2025, it stands out as one of the riskier places to buy a home. The median home price here sits around $500,000, and while that is close to what you see in Henderson or Reno, the crucial detail is that prices are already slipping. Reports show a decline of just over 1% compared to last year. That single percentage point means recent buyers have lost thousands of dollars in equity almost immediately after moving in. The larger problem lies in demand. Home sales in Carson City have dropped by nearly a quarter, with July 2025 seeing 23% fewer homes sold than the same month the year prior. When transactions slow this much, it signals that buyers are staying on the sidelines, either priced out or unconvinced the market has any room to grow. Sellers then compete harder for the few buyers available, which drives down listing prices and puts more downward pressure on values. For homeowners, this creates a frustrating cycle. You are paying high mortgage payments on a property that is not appreciating. Insurance and tax costs are not going down, but the market value of your biggest asset, island. For those who bought hoping to flip or to capture value growth, Carson City is currently a losing bet. There are some silver linings. If you are looking for a quieter community and plan to stay long-term, you may benefit from the cooling market by negotiating a better purchase price. But make no mistake, in 2025, Carson City is not rewarding new buyers. With home values slipping, demand evaporating, and sales at their weakest point in years, it is one of the worst markets in Nevada to buy into right now. 27. North Las Vegas, Nevada. North Las Vegas has always been more vulnerable than its wealthier neighbors, and in 2025, the cracks are once again showing. The median home price here is around $410,000, already down more than 3% compared to last year. That may sound like a small dip, but for families who stretch their budgets to get into the market, it represents tens of thousands of dollars lost in equity in a very short time. The city's challenges run deeper than just price corrections. North Las Vegas has lower median household incomes compared to the broader Las Vegas Valley, meaning buyers are often committing a higher percentage of their paychecks toward housing costs. When the market cools, these households are the first to feel the squeeze. Homes that once sold quickly during the pandemic boom now linger longer on the market, and sellers are resorting to price cuts to attract interest. The lack of strong buyer demand further depresses values and creates a cycle that traps new homeowners in homes worth less than their mortgage balances. Crime rates in North Las Vegas are also higher than state averages, and schools often score below those in Henderson or Summerlin. This affects desirability for families and investors alike. When fewer people want to move in, property values stagnate or decline. Add in rising insurance costs and property taxes, and the total cost of ownership becomes a heavy burden without the equity growth to offset it. There is still some upside if you look long-term. Affordable homes relative to Henderson and Las Vegas proper can draw first-time buyers, and new industrial development may eventually support growth. But in the near term, North Las Vegas remains risky. With prices already falling, slower sales, and weak fundamentals, This is one of the toughest cities in Nevada for home buyers in 2025. 26. Las Vegas, Nevada. Las Vegas is famous for its booms and busts, and in 2025, the housing market is cooling faster than almost anywhere in the country. The median home price is still high, hovering around $430,000, but sales volume has slipped by more than 10% compared to last year. Properties are now taking longer to sell and, on average, homes are closing at about 4% below their list price. For recent buyers, that means their homes are already worth less than what they agreed to pay, and the slide has only just begun. One of the key risks in Las Vegas is oversupply. During the pandemic years, investors and developers flooded the market, banking on endless demand for both vacation properties and long-term rentals. Now, with interest rates elevated and fewer cash buyers, many of those units are sitting empty. High vacancy rates put downward pressure on rents and on resale values. Homeowners counting on rental income to offset costs are struggling, which in turn creates more motivated sellers willing to accept lower offers. The local economy, heavily tied to tourism, is another vulnerability. While visitor numbers remain strong, the volatility of service jobs and dependence on hospitality, mean incomes, are not keeping pace with housing costs. That makes affordability worse and limits the buyer pool for homes from buyers who can weather short-term volatility. Bargain hunters may eventually find deeply discounted properties if the cooling trend turns into a correction. But for anyone buying today with the hope of quick appreciation, the numbers are clear. Las Vegas is one of the worst markets in Nevada this year, with falling sales, declining prices, and excess supply, all pointing in the wrong direction for homeowners. 25. Mesquite, Nevada. Mesquite, located near the Arizona border, is known as a retirement-friendly destination with golf courses, casinos, and warm desert weather. For years, it attracted retirees seeking affordable homes and a quieter lifestyle outside of Las Vegas. But in 2025, Mesquite's housing market is softening in ways that put recent buyers at risk. The median home price here hovers around $390,000, and data shows that values have already dropped by more than 2% compared to last year. For people who purchased during the recent boom, that dip represents a loss of thousands of dollars in equity almost immediately. The sales slowdown is another troubling signal. In late 2024, Mesquite recorded only 6 closed sales in an entire month, a drop of about 25% from the year prior. That kind of decline shows just how thin the buyer pool is in this small city. When demand falls off this sharply, sellers are forced to cut prices in order to move properties, which puts even more downward pressure on home values. Buyers who expected a steady retirement investment are instead finding themselves with assets that are stagnating or sliding backward. Another challenge is the town's narrow economic base. Mesquite depends heavily on retirees and seasonal tourism, leaving the housing market vulnerable when outside demand weakens. Rising insurance costs and property tax burdens only add to the strain, particularly for seniors on fixed incomes. With limited job growth and no major industries outside gaming and leisure, there is little to support stronger housing demand in the near term. That said, Mesquite may still appeal to bargain hunters or retirees who intend to stay long-term. Lower prices could create opportunities for cash buyers unconcerned with short-term equity swings. But for most households, Mesquite in 2025 carries too many risks. With home prices already trending downward, sales falling, and limited economic growth to support demand, Mesquite ranks among the worst places in Nevada to buy a home this year. 24. Fernley, Nevada. Fernley, located about 30 miles east of Reno, experienced a housing boom during the pandemic as buyers looked for more affordable alternatives to the expensive Reno-Sparks area. But in 2025, the tide has turned. Homes that once moved quickly are now lingering on the market. Recent reports show the average property in Fernley sits for about 65 days before selling, up from 60 days a year ago. That increase in time on market signals weaker demand and creates an environment where sellers are forced to drop asking prices just to get offers. Sales activity itself is shrinking. In a recent 12-month period, only 167 homes closed, compared to 189 the year prior. That drop represents a decline of more than 10% in transaction volume. When fewer homes are selling, It is a strong indicator that the market has cooled and that values may be at risk of slipping further. For new buyers, this means purchasing at a time when appreciation is stalling and liquidity is drying up. The affordability advantage that once made Fernley appealing is also eroding. While homes are cheaper than Reno, incomes in Fernley are much lower, which makes ownership difficult when mortgage rates remain high. Rising property taxes and insurance premiums add to the burden, squeezing families who moved here hoping for a more manageable cost of living. With demand softening, those same households risk being stuck with homes that are hard to sell without taking a loss. There may be long-term upside if Reno continues to expand and commuters seek cheaper housing options nearby. But in the short term, Fernley is clearly a risky market. Slower sales, longer listing times, and waning affordability make this one of the worst cities in Nevada to buy a home in 2025. 23. Elko has always been a city tied closely to the mining industry, and that connection creates volatility in its housing market. When gold prices rise and mining companies expand, housing demand grows. But when the industry contracts, the effect on real estate is immediate and painful. In 2024, Elko's home sale prices dropped more than 7% compared to the previous year, wiping away equity for anyone who purchased near the peak. That decline continued into 2025, showing how fragile this market can be. At first glance, Elko may seem like an affordable option. Median prices are far lower than Reno or Las Vegas, which tempts families and investors looking for value. Yet the lower price point hides the bigger risk. Homes here are highly sensitive to the health of just one industry. When local mining companies cut jobs or scale back projects, people leave the area and housing demand vanishes with them. That creates sudden drops in both sales activity and home values. Buyers who enter at the wrong time may find themselves stuck with a property that is worth less than their mortgage within months. The pace of sales also tells a concerning story. Fewer homes are trading hands, and those that do often sit on the market longer than in other Nevada cities. Sellers are cutting prices just to attract attention, which reinforces the perception of a weakening market. High mortgage rates and limited wage growth in Elko only add to the burden for households trying to buy, meaning fewer qualified buyers are available to support prices. For long-term residents who plan to stay and are less concerned with appreciation, Elko can still offer affordable living. But for those seeking a sound investment, this is one of Nevada's most volatile and risky housing markets. In 2025, the numbers show Elko is a place where new buyers are more likely to lose money than build wealth. 22. West Wendover, Nevada. West Wendover sits on the Nevada-Utah border, best known for its casinos and small tourism economy. On paper, that might suggest a steady stream of buyers looking for inexpensive homes in a community with low costs. But in 2025, the numbers tell a different story. In the past 12 months, only 19 homes have sold in this market. That is shockingly low turnover, showing how thin the buyer pool really island. When so few homes are trading hands, it becomes nearly impossible for sellers to get fair value. And buyers who move in often end up stuck in a sluggish market where resale is uncertain. Prices are also slipping. Reports show a decline of close to 3% year over year. In a city where the median home value is already low compared to statewide averages, even small declines translate into painful equity losses for homeowners. For new buyers, this means they are stepping into a market where the direction is clearly downward and where any investment may quickly lose value. The lack of appreciation potential makes West Wendover a risky place to commit to homeownership. The underlying problem is that West Wendover has very little economic diversity. The local economy is dominated by a handful of casinos and small-scale hospitality businesses. When tourism softens, employment opportunities shrink and housing demand falls right along with them. Add in the fact that many workers commute from nearby Utah rather than buying locally, and you can see why the market remains so illiquid. Homes simply sit unsold, often for months, with sellers forced to lower asking prices just to attract any interest. For bargain hunters, this environment might look appealing at first. Prices are low, and competition is almost non-existent. But for most buyers, West Wendover in 2025 is a market defined by slow sales, falling values, and a very narrow base of demand, making it one of the worst places in Nevada to buy a home this year. 21. Lovelock, Nevada. Lovelock, a small town in Pershing County, offers a glimpse of the risks that come with buying in Nevada's rural markets. On the surface, the community is affordable and quiet, appealing to those looking for space away from city life. But in 2025, Lovelock's housing market is showing just how difficult it can be to preserve or grow value in such a place. Homes here sit on the market for an average of 167 days before selling. That means nearly half a year passes before a transaction closes, which is a clear sign of weak demand. This sluggish pace has real consequences for homeowners. A property that lingers for months often requires multiple price cuts, leaving sellers with less than they hoped for and buyers with homes that show little immediate appreciation. Without enough buyers circulating through the market, prices stagnate. Even in cases where listings appear affordable compared to Nevada's larger cities, buyers are essentially tying up their capital in an asset that will be very hard to liquidate later. For those who bought expecting the value of their home to rise over time, Lovelock has proven to be a disappointment. The economic backdrop only reinforces the risk. Lovelock lacks major employers and depends heavily on government services, agriculture, and small-scale local businesses. There is little to drive new demand for housing. Younger populations often leave for Reno or Las Vegas in search of jobs, while the older population that remains does not generate significant growth in the housing sector. This leads to a cycle where fewer buyers enter the market, homes stay on the market longer, and values struggle to climb. While bargain seekers may be drawn to the relatively low entry costs, the reality is that Lovelock offers little in terms of appreciation potential. In 2025, the prolonged days on market, stagnant pricing, and lack of economic activity make it one of the worst places in Nevada to buy a home. 20. Caliente, Nevada. Caliente, a historic railroad town in Lincoln County, looks affordable at first glance, but in 2025 it represents one of the riskiest markets in Nevada. The average home value sits just above $200,000, making it far cheaper than Reno or Las Vegas. Yet prices here have actually declined by nearly 2% in the past year, showing that even low-cost markets are not immune to stagnation. For buyers who moved in expecting at least modest appreciation, that decline translates into immediate losses on paper. The real challenge in Caliente is demand, or rather the lack of it. The community is small, remote, and far removed from major employment centers. With limited job growth, the pool of buyers is shallow. Homes that do get listed can remain unsold for months, and sellers often accept discounted offers simply to move on. This slow pace of sales creates a cycle of weak confidence. Fewer buyers are willing to enter a market where resale is difficult, which further depresses prices. Another factor that weighs down Caliente is its shrinking population. Younger residents frequently leave for larger cities, while the remaining base is older and less likely to drive housing growth. With minimal new development or infrastructure projects to attract outsiders, the city struggles to generate momentum in its real estate market. Insurance and upkeep costs also remain a burden relative to the local income levels, making ownership harder for the few families who do buy. The upside is that Caliente offers low entry costs for those who want a quiet lifestyle and do not plan to sell quickly. However, as an investment, the risks far outweigh the rewards. In 2025, declining values, weak demand, and a stagnant local economy place Caliente firmly among the worst cities in Nevada to buy a home. 19. Carlin, Nevada. Carlin, a small mining town in Elko County, looks inexpensive at first glance, but the housing market here is proving to be unstable in 2025. The median home price sits around $150,000, which is far below state averages, yet prices have dropped by more than 7% in the past year. For households that purchased just 12 months ago, this decline means they are already facing equity losses on properties that were supposed to be affordable investments. The town's dependence on gold mining is the biggest reason for these swings. When gold prices are high, mining operations hire, families move in, and housing demand rises. But as soon as production slows or commodity prices dip, jobs disappear and the population shrinks. That boom and bust cycle translates directly into housing volatility, leaving buyers vulnerable to rapid declines in value. The problem is compounded by the fact that Carlin's population is small, so even slight shifts in employment numbers can cause outsized effects on the housing market. Sales activity has also slowed, and listings now take much longer to move compared to healthier markets. Sellers often end up dropping asking prices, and buyers who entered expecting to resell or build wealth quickly are disappointed. With fewer transactions and declining values, the market is showing clear signs of fragility. At the same time, households here face rising costs of ownership, from insurance premiums to property maintenance, that erode the benefits of buying cheaply. For some buyers, Carlin may still offer appeal as a low-cost entry point into homeownership, but from an investment perspective, it carries more risk than reward. In 2025, the shrinking prices, reliance on mining, and slow pace of sales make Carlin one of the worst places in Nevada to buy a home if your goal is to protect or grow your equity. 18. Fallon, Nevada. Fallon, often called the Oasis of Nevada, has been attractive for families drawn to its agricultural roots and the presence of the Naval Air Station. Yet in 2025, the local housing market is showing worrying signs that make it a difficult place to buy a home. The median listing price is just under $390,000, but that figure is down more than 7% compared to last year. For anyone who purchased a home 12 months ago, that decline represents a tangible loss of equity on what was supposed to be a stable investment. The slowdown is also visible in the length of time it takes to sell a property. In 2024, homes in Fallon averaged just over 1 month on the market. By 2025, that number has ballooned to more than 80 days. This dramatic increase in days on market highlights how weak demand has become, leaving sellers to cut prices and buyers holding assets that may not appreciate anytime soon. Part of Fallon's challenge lies in its economic foundation. While the Naval Air Station provides some stability, much of the local economy depends on agriculture and government spending, sectors that do not generate rapid growth. Younger populations often leave for Reno or Las Vegas in search of broader opportunities, which reduces long-term demand for housing. With mortgage rates still high and wages relatively stagnant, affordability becomes an even greater obstacle for families considering a move here. For long-term residents committed to staying, Fallon's affordability compared to Reno may still hold appeal. But from an investment perspective, the current trends are concerning. Declining prices, sluggish sales, and limited economic growth make Fallon one of the worst places in Nevada to buy a home in 2025, particularly for those hoping to build equity quickly. 17. Yerington, Nevada. Yerington, the seat of Leon County, presents itself as a quiet agricultural town with a slower pace of life. While that appeals to some, in 2025 the housing market is performing poorly, making it a risky place to buy a home. Median list prices hover around $299,000, but that figure has dropped nearly 7% from the previous year. That slide might seem moderate, yet in a small market, it translates into real losses for homeowners and signals a broader weakness in demand. One of the clearest indicators of the slowdown is how long homes sit unsold. In Yerington, the average property spends about 133 days on the market. That is more than 4 months. A timeline that forces sellers to either wait uncomfortably or slash prices to attract attention. For new buyers, this means it will be difficult to resell quickly or at a profit, locking their investment in a stagnant asset. Yerington's local economy explains part of the weakness. The town depends heavily on farming, ranching, and small service businesses, with limited job growth or diversification. Younger residents flat, the housing market lacks the fuel to sustain or grow prices. For long-term buyers who value lifestyle over investment, Yerington may still appeal because of its affordability and rural charm. But for anyone seeking appreciation or resale potential, the risks outweigh the rewards. In 2025, declining prices, extremely long days on market, and a stagnant economy combined to make Yerington one of the worst places in Nevada to buy a home. 16. Sparks, Nevada. Sparks, just east of Reno, experienced explosive growth during the pandemic housing rush. Buyers priced out of Reno turned to Sparks, driving values up quickly. But in 2025, the city's housing market is correcting. The median home price now sits around $509,000, a steep decline of nearly 7% from the previous year. For recent homeowners, this means thousands of dollars in equity have evaporated in less than 12 months. The pace of sales is also slowing. Homes in Sparks are staying on the market longer, reflecting weaker demand. Sellers who once received multiple offers above asking are now cutting prices to attract attention. This shift from a frenzied seller's market to a cautious buyer's market is particularly dangerous for those who purchased at peak valuations in 2022 or 2023. They now face the possibility of being underwater on their mortgages if the downward trend continues. Affordability remains another key issue. Although Sparks is cheaper than Reno on paper, household incomes have not kept pace with rising housing costs. With mortgage rates still elevated, monthly payments remain punishing, straining budgets across the city. Property taxes and insurance costs only add to the burden, making it harder for new buyers to break even on their investments. While Sparks may stabilize long-term thanks to its proximity to Reno's employment base, the near-term risks are hard to ignore. Declining prices, extended days on market, and affordability pressures all point in the wrong direction for homeowners. In 2025, Sparks has become one of Nevada's riskiest places to buy a home, and those who purchased recently are already seeing their investments lose value. 15. Pahrump, Nevada. Pahrump, located about 60 miles west of Las Vegas, gained popularity as a more affordable alternative for people priced out of the metro area. But in 2025, the numbers show that Pahrump is not delivering the value many expected. In one of its main zip codes, median listing prices fell by more than 9% over the past year. That decline translates into tens of thousands of dollars in lost equity for households that bought during the boom. Instead of building wealth, recent buyers are watching their investments shrink. Beyond the decline in prices, Pahrump carries unique challenges tied to its infrastructure. Water is one of the biggest issues. New homeowners often must purchase water rights, which can cost close to $10,000 per acre-foot just to drill a well. This hidden expense makes homeownership far more expensive than the list prices suggest. For retirees and families moving in for affordability, these unexpected costs can quickly turn a cheap home into a financial burden. The town's economy also does not offer the depth to support stable housing demand. With limited job growth, few large employers are simply staying out of the market, leaving homes to linger unsold. Sellers then cut prices further, pushing values down for everyone. For some, Pahrump's low entry prices and wide-open land may still hold appeal, especially for long-term owners who do not mind slower appreciation. But as an investment in 2025, the risks are high. Falling prices, costly water rights, and weak economic fundamentals make Pahrump one of the worst cities in Nevada to buy a home this year. 14. Tonopah, Nevada. Tonopah, once a silver mining boomtown, has become one of the most troubled housing markets in Nevada. At first glance, homes here look extremely affordable, with the median sale price hovering around $88,000. But that figure has fallen nearly 10% over the past year, showing that even bargain-priced properties are losing value. For buyers, that means equity is eroding quickly, and the very feature that makes Tonopah appealing, its low prices, is also a red flag signaling limited demand. The biggest challenge in Tonopah is its remoteness. Located midway between Reno and Las Vegas, the town has little in the way of a diversified economy. Mining jobs are limited, tourism is minimal, and there are few large employers to anchor demand. As a result, the housing market relies mostly on local turnover, which is too thin to sustain appreciation. Homes sit on the market for months, and sellers often reduce prices significantly to get any traction. This lack of demand feeds into a cycle of stagnation. With few buyers coming in, values struggle to recover from declines. New residents who hope to capitalize on low entry costs often find themselves holding a property that does not appreciate and may be nearly impossible to resell without taking a loss. Maintenance and insurance costs also remain burdensome relative to the extremely low home values, making ownership less affordable than it appears on paper. While Tonopah may appeal to niche buyers looking for cheap property in a historic desert town, from an investment standpoint, it is risky. In 2025, steep price declines, limited economic growth, and weak buyer interest have made Tonopah one of the worst cities in Nevada to buy a home. 13. Enterprise, Nevada, Southwest Las Vegas. Enterprise, a master-planned community in Southwest Las Vegas, grew rapidly over the last decade as new subdivisions and luxury homes spread across the desert. It was once considered one of the hottest housing markets in Nevada, but in 2025, it has become a cautionary tale. The median home price sits at roughly $500,000, but values have fallen close to 10% over the past 12 months. For buyers who purchased during the peak years of 2022 and 2023, this means they are already sitting on significant equity losses. The pace of construction in Enterprise has left the area oversupplied. Builders raced to keep up with demand during the pandemic boom, and now the market is flooded with new homes competing for a shrinking pool of buyers. With mortgage rates still elevated, fewer families can qualify for loans at today's prices, and many homes are staying on the market much longer than expected. Sellers are forced to cut prices or offer incentives, dragging down neighborhood values in the process. Enterprise also reflects the broader vulnerabilities of Las Vegas. Jobs and the burden for new homeowners. These financial pressures are magnified in Enterprise, where large, newer homes carry higher maintenance costs. Buyers who stretch their budgets to purchase here now face both declining values and high carrying costs, creating a recipe for financial strain. While the long-term outlook could improve if Las Vegas sees another surge in population growth, the short-term risks are severe. Enterprise in 2025 is a market where homes are losing value quickly, supply is outpacing demand, and affordability has collapsed. For anyone looking to buy a home now, it ranks among the worst choices in Nevada. 12. Paradise, Nevada, Las Vegas Strip area. Paradise, the unincorporated area that includes the Las Vegas Strip, has long been one of the most recognizable real estate markets in Nevada. Luxury condos, high-rise apartments, and tourist-driven properties once drew investors from across the country. But in 2025, the market here is showing steep declines that make it one of the riskiest places to buy. The median listing price is around $409,000, yet values have plunged nearly 15% compared to the previous year. For new buyers, that means their homes are losing value faster than anywhere else in Clark County. A big part of the problem lies in oversupply of high-rise condos and luxury units. Developers built aggressively to meet investor demand, but as interest rates climbed and short-term rental profitability declined, many buyers pulled back. With fewer out-of-state investors and a smaller pool of local residents able to afford high monthly costs, properties are sitting unsold. Sellers are forced to cut prices significantly, driving down values across the board. The volatility of the Strip economy adds another layer of risk. While tourism remains the lifeblood of Las Vegas, it is highly sensitive to economic downturns. Even modest slowdowns in visitor spending can ripple through to job security, wages, and ultimately housing demand. Paradise, being so heavily tied to tourism and investment properties, feels these shocks faster than suburban neighborhoods. Insurance and association fees also weigh heavily on condo owners, often adding hundreds of dollars a month to housing costs. When property values are already dropping, these extra expenses can turn ownership into a money-losing proposition. For buyers expecting steady appreciation, the reality is far different. In 2025, Paradise is a market defined by 11. Laughlin, Nevada. Laughlin, located along the Colorado River, has built its reputation as a resort town with casinos and boating, attracting both tourists and retirees. However, in 2025, its housing market has taken a sharp downturn that puts recent buyers in a difficult spot. The median listing price is just over $220,000, but values have fallen nearly 13% from the year before. For homeowners who moved here expecting appreciation, that kind of decline has erased years of potential equity growth in just 12 months. The pace of sales also tells a troubling story. Homes in Laughlin now sit on the market for close to 3 months before finding a buyer. That extended timeline signals weak demand, leaving sellers to reduce prices significantly to close deals. This weak market dynamic means new buyers are immediately exposed to the risk of further depreciation, while also facing the challenge of trying to resell in a sluggish environment. The local economy contributes to these challenges. Laughlin depends heavily on casino tourism, and while visitors still come, the industry no longer drives the kind of robust growth it once did. With limited job opportunities outside hospitality, there is not enough economic diversification to support steady housing demand. Younger families often bypass Laughlin in favor of larger cities with stronger economies, which leaves a smaller buyer base to sustain values. For retirees seeking low-cost housing, Laughlin may seem attractive because of its riverfront location and relative affordability. But those advantages do not outweigh the risks tied to falling prices, sluggish sales, and a narrow economic base. In 2025, Laughlin stands out as one of Nevada's weakest housing markets, making it one of the worst places to buy a home for anyone concerned about protecting their investment. 10. Boulder City, Nevada. Boulder City has long been known as a historic community near Hoover Dam, with strict growth controls designed to preserve its small-town character. While those rules once created stability, in 2025 they have become a double-edged sword. The median home price now sits around $415,000, a sharp decline of about 15% from the previous year. That drop means buyers who entered the market recently have seen tens of thousands of dollars in equity vanish in less than a year. The slowdown is partly due to limited new population growth. Boulder City restricts development more tightly than almost any other Nevada community, which can artificially inflate prices in boom years but leaves the market fragile when demand weakens. With higher mortgage rates and fewer buyers entering the market, the limited supply advantage has disappeared. Homes now sit on the market longer, and sellers are lowering asking prices to attract attention, creating a downward spiral for property values. The town's demographics also pose challenges. Boulder City has an aging population, and younger households often bypass it in favor of communities with more jobs and amenities. That reduces the pool of potential buyers, further depressing demand. Rising insurance costs and property taxes add to the financial burden, making it even harder for families to justify buying in a city where values are falling. While Boulder City offers charm, history, and proximity to Lake Mead, the housing market is not rewarding new buyers. The strict limits on growth mean that once demand softens, recovery takes longer than in other Nevada cities. In 2025, Boulder City stands out as one of the worst places to buy a home, with steep price declines, stagnant demand, and limited prospects for quick appreciation. 9. Winnemucca, Nevada. Winnemucca, often called the Crossroads of the West, has traditionally been seen as a modest, stable community, anchored by ranching, trucking, and some mining operations. But in 2025, its housing market looks dangerously overheated. Over the last year, median home prices have skyrocketed nearly 50%, reaching levels that are wildly out of step with the city's income base and economic fundamentals. For new buyers, that sharp rise should be a warning sign rather than a badge of prosperity. Sudden surges of this scale are almost always followed by equally sharp corrections. The problem becomes clearer when you look at how long homes are taking to sell. Properties in Winnemucca now sit on the market for more than 100 days on average before closing. That combination of soaring prices and sluggish sales is unsustainable. It shows that while some transactions are happening at inflated levels, the broader market is unable to absorb inventory. Sellers are asking far more than most local households can afford, leaving homes unsold and price cuts inevitable. For those who bought at the recent peak, this creates a high risk of falling into negative equity as values correct downward. Economic conditions in Winnemucca only magnify the risk. The local economy depends heavily on trucking and mining, industries that are cyclical and sensitive to global trends. Employment can fluctuate significantly, and wages here have not kept up with the kind of price increases the housing market has seen. Without a strong inflow of higher-paying jobs, there is no solid foundation for home prices to remain at today's inflated levels. This mismatch between housing costs and household incomes makes the market especially vulnerable to a sharp downturn. Winnemucca may still appeal to certain buyers looking for small-town charm or proximity to outdoor recreation. But from an investment perspective, it carries serious dangers. The rapid rise in prices, extended days on market, and weak economic fundamentals combine to make this market highly unstable. In 2025, Winnemucca stands out not as a success story, but as one of Nevada's most overvalued and risky housing markets. Buyers stepping in now could find themselves trapped in properties worth far less within just a few years. 8. Battle Mountain, Nevada. Battle Mountain, located in Lander County, has often been described as a small town with outsized real estate challenges. In 2025, it is one of the clearest examples of how oversupply and weak demand can devastate a housing market. The median listing price here is around $235,000, but what stands out more than the price is the sheer number of homes available. More than 70 properties are currently on the market in a town of fewer than 4,000 residents. That level of inventory would be concerning even in a major city. In a small rural town, it is a recipe for stagnation. Homes in Battle Mountain regularly sit unsold for months, with sellers forced to cut prices to generate interest. Buyers who purchased during the pandemic surge are already watching values slip, as too many homes chase too few buyers. This imbalance pushes the market into a cycle where appreciation is almost impossible. Instead of building equity, homeowners are finding themselves trapped with properties that have little liquidity and declining value. The local economy offers little to support stability. Battle Mountain depends heavily on mining, an industry that fluctuates with commodity prices and employment cycles. When mining slows, families move away, further shrinking the buyer base. With limited diversification, the town cannot sustain steady growth in housing demand. Wages remain modest, meaning that even with relatively low prices compared to Nevada's urban centers, affordability remains an issue for many locals. Investors are especially at risk here. The rental market is thin, vacancy rates are high, and it is difficult to generate reliable income from properties. Combined with declining sales prices, this makes Battle Mountain a poor choice for those seeking returns. For homeowners, the risk lies in being unable to sell when circumstances change, since buyers are scarce and competition is intense. While the community may appeal to those looking for inexpensive living in a quiet rural setting, the risks from an investment perspective are overwhelming. In 2025, Battle Mountain stands out as one of Nevada's weakest housing markets, defined by high inventory, sluggish sales, and limited economic drivers. For new buyers, it is a market more likely to cause losses than gains. 7. Incline Village, Nevada. Incline Village, perched on the north shore of Lake Tahoe, has long been regarded as one of Nevada's most prestigious housing markets. Its stunning scenery, luxury homes, and status as a tax-friendly haven have drawn wealthy buyers from California and beyond. Yet in 2025, this once reliable market has flipped into one of the riskiest places to buy. The median home price now sits around $1.2 million, but values have collapsed nearly 29% in the past year. For recent buyers, that translates into hundreds of thousands of dollars in evaporated equity almost overnight. The reasons behind this steep decline are clear. The pandemic years saw a flood of affluent buyers pushing prices far beyond sustainable levels. Now, with interest rates still elevated and stock market volatility cutting into investment wealth, that demand has evaporated. Homes that once sparked bidding wars are sitting unsold, and sellers are slashing prices to attract attention. Luxury markets are especially vulnerable in downturns, and Incline Village is no exception. The higher the entry cost, the more painful the equity losses become when values fall. Another challenge for Incline Village is liquidity. While the area attracts wealthy second-home buyers, that buyer pool is small and highly sensitive to broader economic conditions. When investors pull back, sales volume dries up. Homes can sit on the market for months, and owners often have to accept significant discounts. For families or retirees who stretch to purchase in this community, that means facing ongoing carrying costs like high property taxes, insurance premiums, and homeowners association fees, without the benefit of rising values to offset them. There is still undeniable lifestyle appeal here, with Lake Tahoe's outdoor recreation and luxury amenities. For those with the wealth to ride out market volatility, buying may eventually pay off over the very long term. But for most households, Incline Village in 2025 is a dangerous bet. With steep price declines, a shrinking buyer pool, and heavy ownership costs, this once glamorous market has become one of Nevada's worst places to buy a home. 6. Pioche, Nevada. Pioche, a historic mining town in Lincoln County, is rich in frontier history but poor in housing prospects in 2025. At first glance, the community offers affordability, with median home prices in the mid-$200,000 range. Yet values here have slipped in the past year, and the bigger concern is how long homes remain unsold. On average, properties in Pioche now sit on the market for 110 days before finding a buyer, more than double the pace seen just a year ago, when homes averaged 47 days on the market. That slowdown tells a clear story of dwindling demand. The prolonged listing times weigh heavily on both sellers and buyers. Sellers are forced to reduce asking prices repeatedly, eroding neighborhood values, while buyers who move in may find themselves locked into an asset that is nearly impossible to resell at a profit. With so much inventory relative to the town's tiny population, appreciation becomes unlikely. Instead, properties depreciate simply because there are too few people willing or able to purchase them. Pioche's economy contributes to the weakness. Once a bustling mining hub, today the town depends on small-scale tourism, ranching, and service jobs. Employment opportunities are scarce, younger generations continue to leave, and population decline further thins the pool of prospective homeowners. Without meaningful economic diversification or new industries, housing demand is not just weak, it is shrinking year after year. From an investor's perspective, Pioche is particularly risky. Rental opportunities are limited, vacancy rates are high, and there is little consistent demand to support income-producing property. For owner-occupiers, the risks are more subtle but just as damaging. Equity erosion, higher carrying costs relative to stagnant property values, and the likelihood of difficulty reselling when circumstances change. There are those who may value Pioche's quiet pace, low prices, and historic character. But the reality is that for anyone concerned about building or protecting wealth, this market is a trap. In 2025, Pioche stands out for its sharply slowing sales, falling prices, and stagnant economy, making it one of the worst places in Nevada to buy a home. 5. Hawthorne, Nevada. Hawthorne, the small community in Mineral County often referred to as the America's Patriotic Home, may be rich in history and surrounded by scenic desert landscapes, but its housing market in 2025 is struggling. The median home price here is about $166,000, which makes it one of the cheapest in Nevada. Yet instead of offering a safe entry point, prices have fallen by more than 10% in just the last year. For new buyers, that kind of decline means their investment is worth less almost immediately, erasing equity before it has a chance to build. One of the most alarming indicators is the sheer volume of inventory relative to the town's size. Nearly 50 homes are currently for sale in a community of only about 2,500 residents. That level of supply overwhelms the available demand, leaving many properties to sit unsold for months. Sellers are cutting prices repeatedly just to generate interest, and each discount further drags down neighborhood values. For buyers who entered the market expecting appreciation, the reality is prolonged stagnation and a very real risk of financial loss. The local economy adds to the instability. Hawthorne has long been tied to the U.S. Army Depot, but its workforce has declined over time, leaving fewer stable jobs to sustain housing demand. With limited private sector growth and few opportunities for younger workers, the town has seen population stagnation. Fewer households mean fewer potential buyers, making it even harder for sellers to exit the market without sacrificing value. For investors, Hawthorne presents additional risks. The rental market is thin, vacancies are common, and generating consistent income is difficult. For owner-occupants, the challenge lies in affordability relative to stagnant wages, and the possibility of being trapped in a home that cannot be sold without a significant loss. While Hawthorne may offer extremely low entry costs for those looking for quiet, small-town living, from an investment standpoint, it is one of the weakest markets in Nevada. In 2025, the combination of steep price declines, excessive inventory, and limited economic drivers makes Hawthorne a high-risk and low-reward place to buy a home. 4. Ely, Nevada. Ely, tucked in White Pine County, is a former mining hub that has struggled for years to reinvent itself. In 2025, its housing market is among the weakest in the state. The median home price has dropped to roughly $139,000, which is startling because it represents a decline of nearly 33% from the year before. For buyers who entered the market recently, that drop means they have lost a third of their home's value in less than 12 months, an almost unprecedented equity wipeout in such a small community. The demand side of the market is deeply troubled. Ely's population is stagnant or even shrinking as younger generations leave in search of jobs and amenities available in larger Nevada cities. With fewer households moving in, the buyer pool is incredibly thin. Homes that do come on the market often sit unsold for long stretches, forcing sellers to slash prices again and again. This constant cycle of discounting feeds into the broader perception of a market in decline, discouraging potential buyers and trapping current owners in a downward spiral. The local economy compounds the housing challenges. Ely remains dependent on mining and some tourism, but neither provides enough stability to sustain strong housing demand. Employment is limited, and incomes are modest, which means fewer residents can afford to buy homes even at lower price points. Infrastructure development has been minimal, and there are few major projects on the horizon to suggest a turnaround. As a result, the real estate market reflects the broader economic malaise. For investors, Ely is one of the riskiest bets in Nevada. The rental market is unreliable, vacancies are common, and appreciation potential is almost non-existent. For homeowners, the problem is just as severe. Steep equity losses, long selling timelines, and the likelihood of being locked into a property worth far less than what they paid. While Ely offers small-town charm, affordability, and access to outdoor recreation, from a financial perspective, it is a trap. In 2025, Ely's collapsing values and weak demand place it firmly among the worst cities in Nevada to buy a home. 3. Eureka, Nevada. Eureka, a historic mining settlement with a population of only a few hundred residents, may be rich in heritage, but it is one of the poorest performers in Nevada's housing market in 2025. The first sign of trouble is liquidity. Homes in Eureka now average more than 230 days on the market before selling. That is nearly 8 months, an eternity in real estate. Such lengthy listing periods mean that even if you can find a buyer, it will take heavy discounts and a long wait, leaving homeowners with little leverage and eroding confidence in the market. Price trends offer no comfort. Instead of modest appreciation, values here have remained stagnant, with growth hovering near zero over the past year. In practical terms, this means anyone who has purchased a property is sitting on an asset that is not increasing in value, while still paying the costs of ownership such as insurance, taxes, and maintenance. Over time, this imbalance makes homeownership in Eureka less of an investment and more of a liability. The root cause is the town's economy, or lack thereof. Once sustained by mining, Eureka has not seen major new industries arrive to replace the old ones. Employment opportunities are scarce, wages are modest, and younger generations continue to leave for larger cities with more robust job markets. This constant outflow of residents means there are fewer buyers each year to absorb available inventory. Without new households moving in, housing demand is effectively frozen. For investors, Eureka offers virtually no upside. Rental demand is minimal, vacancy rates are high, and the few tenants available often cannot support higher rents. For owner-occupiers, the picture is not much better. With homes sitting unsold for months, any attempt to relocate or cash out becomes an uphill battle that often ends in financial loss. While Eureka may appeal to history lovers or those seeking a quiet escape, from a real estate perspective, it is a dead end. In 2025, the combination of stagnant values, excessive days on market, and a shrinking population makes Eureka one of the very worst places in Nevada to buy a home. 2. Wells, Nevada. Wells, a small city in Elko County, represents one of the most dramatic housing downturns in Nevada in 2025. The numbers are staggering. In a recent 12-month period, the median home price in Wells plunged by more than 90% compared to the year before. This was not a minor correction, but a complete collapse in values, reflecting the sale of only the lowest-priced properties, while higher-end homes simply did not move. For buyers who purchased before the crash, this means their equity has effectively evaporated, leaving them locked into homes worth a fraction of what they paid. The problem is not just price declines, but also liquidity. Properties in Wells now sit on the market for over 200 days on average before selling. That is more than half a year, which makes real estate here incredibly illiquid. For anyone who might need to relocate or sell quickly, the odds of finding a buyer without steep price cuts are slim. This slow turnover further depresses confidence in the market, trapping owners in a cycle of stagnation and decline. Wells's economic foundation explains much of the weakness. The town has limited employment opportunities, relying heavily on small-scale services, trucking, and the broader Elko County mining sector. As jobs fluctuate, people often leave, shrinking the buyer pool further. With few new households moving in and younger generations departing for larger cities, the demand side of the housing market continues to collapse. Investors are especially at risk here. Rental demand is thin, vacancy rates are high, and it is difficult to generate reliable returns in such a small, shrinking market. For owner-occupants, the challenges are just as severe. Carrying costs, even on inexpensive properties, add up quickly, and the lack of appreciation means those expenses are unlikely to be offset by rising values. While Wells still offers very low entry prices and quiet rural living, it is a textbook example of a housing trap. In 2025, the devastating price collapse, extreme time on market, and limited economic prospects make Wells one of the very worst cities in Nevada to buy a home. 1. Goldfield, Nevada. Goldfield, once the largest city in Nevada during the early 20th century mining boom, is today little more than a ghost town with a few hundred residents. Its storied history may attract tourists and history buffs, but the housing market in 2025 is one of the weakest in the entire state. The median home price hovers around $147,000, yet that number is misleading because properties often sit unsold for months on end. On average, homes remain on the market for more than 180 days before finding a buyer. That kind of timeline shows just how little demand exists, making real estate here both illiquid and risky. The biggest problem with Goldfield's market is that there is almost no economic base to sustain it. The once thriving mining industry is long gone, and the town has not replaced it with new industries or significant infrastructure investment. Employment opportunities are scarce, wages are low, and younger generations continue to leave in search of better prospects. Without job growth or population inflows, housing demand is virtually non-existent. For those who do purchase, appreciation potential is almost zero, and resale can be nearly impossible. The small size of the market magnifies these issues. With so few transactions each year, even one or two distressed sales can drive median prices down sharply. That volatility adds to the uncertainty for new buyers, who risk holding a property that could lose value overnight simply because of one low sale in the neighborhood. Carrying costs such as insurance, utilities, and taxes may be modest in dollar terms, but they become heavy when the property itself generates no financial return. For investors, Goldfield offers no meaningful rental market, leaving little opportunity to generate income. For homeowners, the town's isolation and lack of services make it impractical unless one is committed to living there long-term without concern for property value. The reality is that for anyone expecting a home to function as both shelter and an investment, Goldfield delivers only on the first. In 2025, Goldfield's declining demand, stagnant economy, and long selling times cement its place as the single worst city in Nevada to buy a home. And there you have it, the 30 worst cities to buy a home in Nevada in 2025. From collapsing values to homes sitting unsold for months, these markets show just how risky real estate can be if you don't know where to look. But remember, even the weakest markets can sometimes hide opportunities for smart and patient buyers. Which of these cities surprised you the most? Let me know in the comments below. I'd love to hear your take. And if you found this breakdown helpful, don't forget to like, share, and subscribe for more real estate insights every week.